Okay, good evening, everyone. Thank you for joining here. First and foremost, hope everyone's doing well, staying healthy, etc. Hope you had a nice summer, all things considered, which I know is a new environment when I get asked the question of how's the summer been going. So we're going to go ahead and jump right in. We're looking forward to tonight. We definitely want to get some engagement from those of you that are listening in. For this webinar, we're going to just talk through underwriting and sort of what we're adjusting for in the wake of COVID-19. So we're going to touch a little, well, I'll run through the agenda, but I think it's a unique meetup, and it's one where there's not necessarily a right answer. So I think it'll be interesting to just hear different perspectives. Donato and I will offer different vantage points, and like I said, we welcome yours on the webinar tonight. So as always, just usual disclaimer: this is for informational purposes. As always, you're encouraged to. This is not an investment offering. You're encouraged to speak with your own accountants or financial advisors or consultants before making any investment decisions. So finding opportunity among uncertainty, I think that's really the environment that we're in today. At the end of the day, there really is just a lot of uncertainty. So really choosing and making that right decision is important. So today we're going to give a very quick background on us, founders. We're going to speak to, mostly at a high level, just the impact of COVID-19, maybe touch on the upcoming opportunity, speak to just differences on the lender side. That world has definitely changed, and frankly, very quickly. And that's impacting pricing and underwriting at the end of the day. Equity, what's changed there, expectation differences, underwriting, and what's really changed, and again, what's up for debate, and how different groups may be underwriting more or less aggressively in different circumstances. A quick market update, how it all comes together, and then always we are available. We do these webinars really with the intention of connecting both with people that we know already and people that we don't know. So we welcome the opportunity for those of you on the call to learn a little bit more. So about us, we're a value-oriented real estate investment firm. Our founders here are located in the New York metro area. We are mostly, I'll say predominantly 98% focused on value-add multifamily investments. We take a very data-driven approach to really identifying target markets and the opportunities themselves. Our acquisitions really now and for the foreseeable future are going to be in the Southeast, multifamily centric, and we'll speak to some of the why there. But I think many of you on the call are already thinking multifamily for many of the downside oriented reasons, and perhaps the outsized upside reasons. A little bit about us. We've acquired about $50 million worth of real estate, a little bit more than that, over 600 units. We have been doing this for about 8 years across 7 different states, although I will admit our regions now that we're investing in are a little bit more centralized to really 3 or 4 states where we're willing to look at this point. But we work really very closely, our investors, work with individuals that are mid 1031, and then we've had, I think, 20 to 30% of our investors are self-directed IRA participants. I'll touch on myself really quick. My name's Josh Eidengon. I'm one of the managing partners of DXE. My background is predominantly on the front end of deals. First was an analyst and an acquisitions guy, where I led in the acquisition of over $100 million worth of multifamily value-add garden-style real estate. After 4 or 5 years with that firm, peeled off and co-founded DXE with my partner, Donato, who I'll let introduce myself and brings a little bit of a different background.
Good evening, everyone. Again, thanks for joining. If you came a little late, we didn't say anything important anyways. That was a terrible joke. But anyways, a little bit about myself. My name's Donato Satani. My background's a little bit different than Josh's. Most of my background was in New York City, specifically Manhattan, institutional-sized real estate. So out of college, I worked for a large construction company, built Yankee Stadium, did Madison Square Garden renovation. After that, I went back to school and got a master's degree in real estate development. From there, I had the opportunity of building a 100-story tower in the middle of Midtown. And most recently, before branching out and creating DXE with Josh, I was working for Oxford Properties, which is a $50 billion real estate investment firm with their US headquarters located in Manhattan.
Perfect. So a little bit into maybe the guts of the presentation here, but what we do want to speak to briefly, well, not briefly, but really to set a framework for the discussion is COVID-19. So obviously a pandemic, I mean, beyond the disruption to the economy, obviously lives being lost, and it's a very serious pandemic being dealt with. How does that trickle down and relate to real estate? Obviously, different asset classes are being treated differently in a lot of cases, but speaking multifamily centric, I think there's a few items that are worth just calling out and really being driven by the government's involvement to provide support in what's been nothing short of a significant impact that really has not been seen before. So number one, agency lenders, meaning Fannie and Freddie, very quickly began offering just deferral of loan payments. So it came in a few different options and forms, but ultimately they allowed an initial 3 months to be deferred in your mortgage payments, then to be paid back over 12 months. So that's shifted that initial burden of payments. If you hit a very hard time, that provided some relief. Although again, that relief did not disappear forever. After that initial deferred loan payment, agency lenders actually offered a couple different alternatives to pay back, but really none of this was relief driven. They're more so just paying back over different periods of time to provide some again, semblance of deferral as you're operating and allow you to continue operating. Number two, which I do think had a pretty significant impact and really bolstered just multifamily collections for months, both number 2 and 3, were just the federal stimulus checks. So as everyone's seen, read about, received, checks were sent directly to people, $1,200 checks, give or take, depending on your income. And that really provided some level of just immediate support, especially perhaps less so in the higher cost, maybe if you're on the coast, New York Metro or San Francisco or LA, $1,200 probably won't do much for you in terms of covering housing and allowing to live individually. But in Midwest or Southeast or some of these lower cost alternatives, a $1,200 rent check towards rent could easily cover a full month's rent in a lot of cases. So it had some benefit. There's obviously been talks about what's next, and that still remains to be seen, but it certainly seems like Congress is stuttering in terms of what's going to come out and ultimately provide that additional wave of relief. And then on top of that, enhanced unemployment benefits. So I think I give the government credit, especially on these two items. I do think what happened was unbelievably significant in terms of just the stoppage of movement and the economy and job loss. So they jumped into action and really provided support for months here. So as we know, there was enhanced unemployment, up to $600 a week additional to the unemployment that you were receiving. That has since expired, but it certainly helped just bolster and allow people to continue um, just just covering their living expenses. Um, all of these items, really all three of them, have since trailed off. So you've probably seen and read that multifamily has been really, really strong throughout all of this, especially when you compare it to other asset classes, whether it be retail or office, hotels, obviously short-term rentals. Understandably, we're hit with such extremes. The question here is going to be how long lasting are the impacts of job losses, and did these benefits provide enough to prevent any real meaningful distress in the asset class? I think as a counter to that, and perhaps really significantly, and if you look at different forecasts, whether it be NREI or Mike Bibby who's with National Multifamily Housing, he's always putting out different forecasts and great data there. But everyone does say the same thing, and I think it's known and agreed upon that the demand on the multifamily side, no one expects to disappear. Especially after COVID-19 and the impact to just people's individual pockets. There's going to be a continued need-based renting demographic that's going to be there. So you have millennials that everyone talks about, really aging and hitting their stride and they're right in sort of the heart of the prime renting age and demographic. Not on this slide is Gen Z, which is actually a larger demographic than millennials, which are now starting to age into the prime renting age range. So you're just going to have continued renters for a long period of time. I mean, we're big believers in the Southeast in particular, where people and jobs, frankly, are moving just for ease of doing business and affordability, as well as just lifestyle. And we don't think that trend's going to end.
All right, so tonight, just taking that information as a background, what we wanted to do is just show you guys a live deal. This deal is currently in the market. The offer date is actually tomorrow morning on this first round of offers. This is a project that we will be offering on tomorrow. So it is a very real project to us, and we thought, what better than show you all something that's real instead of just making something up for this presentation. So this project is called Riverside Flats at Aberfoyle Village. It's in Belmont, North Carolina. It's a very much up and coming suburb of Charlotte. It's actually just west of Charlotte International Airport. It's a brand new deal. It just finished lease up, constructed in 2018, 2019. It came out of the gate really strong, and now the owner basically is looking to sell to go invest his money elsewhere.
So before we go on to the next slide, I know this is obviously a brand new deal. Do you want to speak just profile what attracted us to it, and maybe on the heels of my doom and gloom paired with some opportunity, where you think, what are the profiles that you like in the wake of COVID-19, and why we are offering on this deal? And it's one deal that admittedly is on our short list of pipeline deals that we're chasing.
Yeah, sure. So what we're really looking for is a couple profiles right now. We like this profile, a Class A brand new deal. It's in a submarket where development has been a little bit limited compared to the rest of Charlotte. This municipality is a bit pickier in the amount of development that they allow at one given time, so it kind of keeps the supply down. The rest of Charlotte, although is an enormously great market and we want to own more in Charlotte, they are definitely more laissez-faire with development. So this particular project, what we see here is we see really a gap to market rents. They've leased this up really quickly. And in doing so, they really didn't push rents. And now the developer of this wants to go take the profits from here and deploy their capital elsewhere. So we think there's an opportunity to gain that, mark to market rent. And also the debt right now for these Class A projects, because delinquency and bad debt has been so low for Class A compared to Class C type multifamily deals, the debt is just, the rates are very attractive right now. So on a project like this, we're underwriting, to 9, 10, 11% cash on cash return per year in a project like this. So it's just really attractive. You get into something that's brand new. And the other thing that's really important, and we'll go through in a little bit, is investing right now requires a lot more equity than did a couple of months ago. So if you're going into a big heavy lift value add deal, a lot of what we're seeing is you just don't have, by the time you bring all the equity, because you're not going to get the leverage, it just doesn't make sense right now. So we think this is a, call it lower risk type option for us, at least in the market.
Yeah, I mean, so that's one profile that we obviously believe in today. And I would say to that point, it's definitely selective Class A, especially in this environment, given how much has been built over the last few years in some of these markets. You really do have to be very mindful of just absorption, lease up, and not step into something that is just doomed to compete with X number of units coming online. But in the same breath, we believe that the right opportunity is very, can make a lot of sense. I think number two, just in terms of profiles that we're open to and chasing, number two would just be what we always like are just a long-term ownership story, or deals with a story where there's some just legitimate upside, even dealing with financing restraints. If you are able to just create value in a way from someone, especially through low-hanging fruit type improvements, those are the deals that we aren't going to shy away from. The lending environments change, and we'll speak to that, and you have to adjust accordingly. But it's a profile that still exists, and value add strategy is never going to not exist.
Yep. And we'll go back to that and the conclusion after we go through how underwriting's changed and, why and how we're looking at certain segments of the market. So I'll run through this quickly just to, again, this is only to get you guys a little bit familiar with the deal that we're talking about here tonight to see how the underwriting has changed. So again, it's in Belmont, North Carolina. The property is 102 units. The year built was 2019. Average unit size is 922 square feet. Current occupancy is 98%. While we were underwriting, I think it was actually pre-leased to 100% per one of the rent rolls that I was looking at. Current average rents are about $1,200. So, what has changed in the marketplace since pre-COVID-19, the beginning of 2020? It was literally like the roaring 20s. Everyone was bullish. We had a long run of economic expansion, but all economic indicators were still pointing towards green. So that was leading to a lot of competition amongst investors and also amongst lenders to get your business. All that has changed now because of COVID-19. So how has that changed? And more importantly, how does that affect the underwriting? So we wanted to go specific here and not just talk in generalities. So there's 3 significant changes affecting multifamily debt markets. Number one, Fannie Mae and Freddie Mac, some of that were the largest multifamily lenders, have lowered the proceeds from a max of 80%. In some cases, you could have gotten 83%, which was 80% plus 3% of closing costs pre-COVID, to now a max of 75%. So on this deal that we're underwriting, we are assuming that the end contract price is going to be somewhere around $21.5 million. So on that $21.5 million deal, lowering from 80% to 75% requires another $1 million in equity. That $1 million in equity computes out to about a 2% change in the IRR. So that small change in lender underwriting just right there forces you to go get another $1 million in equity. Then on top of that, lenders are now requiring much greater upfront reserves. So Fannie Mae and Freddie Mac are both, if you're going for max leverage, which again is 70 to 75% right now, they're both requiring upfront debt, tax, and insurance reserves of a full year. So in this example, that computed out to $800,000 in additional equity that you had to bring to the project, or 1% in the IRR as compared to how we would have underwrote this pre-COVID. The next thing that's really changed is the bridge debt market has essentially collapsed. We are hearing that there's some select players that are coming back to the table, but we went through this in April. We were closing on a deal in Augusta, Georgia. We like the deal a lot. We own it now. We're in a heavy renovation right now, which is going very well. But we decided and opted to go into bridge debt with that project because it was more advantageous to us. As we were trying to get the deal closed in mid-April, we received a call from the bank who basically said, hey, I know there's COVID-19 going on, and you probably want to delay your closing to see how this all shakes out. But if you don't close in 14 days, I'm afraid there's no money left for you. So that's a real story that we dealt with on a real investment. And it was honestly a scary time. And what we learned was we were literally one of the last loans to close with that bank. They did fully fund us. So we did end up getting out scot-free because they liked our deal the best, basically, out of the deals they had in the pipeline. But there was a major collapse in that bridge debt market, and there was a lot of haircuts being taken. And most of that was because those bridge debt providers then go on the secondary market. They package those loans together and sell them to other banks. And what was happening was, because of the uncertainty, even though the loans were still performing, because of the uncertainty, the market for buying those packaged debt like really tightened up. So instead of buying something for, $1 on a dollar, these bidders were offering 70 cents on a dollar. So if you closed the deal last week and now you packaged it together, you were losing 30% of your money in a week. So obviously the bridge debt providers did not want to make that deal anymore and stop lending. What's the good news out of all this? The good news is the agencies are still lending, and although they've tightened their requirements a lot, the rates are just unbeatable right now. The rates are extremely competitive. For this deal, we're looking at a quoted rate of 3%. Josh, correct me if I'm wrong. I think it was actually below 3%, yeah, like to 2.9% or something. So just imagine if you're buying a deal and you're able to lever it at 2.9%, and then your cap rate going into that deal is like a 5.25%. You're making a huge spread on that money. So over a 2-point spread on that money, which makes investments very, very attractive.
Yeah, I mean, and this actually in the more recent term, right now, green program loans have gotten very aggressive because agency lenders do have to get out that money. So it wouldn't apply for this property, which is obviously brand new. But when you are looking at value add oriented deals, you could see rates being quoted, even lower than that, more like 2.6, which is just, historic type commercial rates. For those, I did, the questions are good. And if you want to type in, that's fine. Or if you want to raise a hand, we're happy to unmute as we go here. But, we haven't seen much on the Fannie side actually requiring up to 18 months. I've heard of it more on the Freddie side. And I also do know that small balance, meaning loans less than $5-6 million, really $6 million, they are being even more conservative than more traditional loan products from Fannie and Freddie. But that said, especially really right at the beginning of this, when all lenders were changing their standards, 18 months was being thrown around. I have not really seen it come into play directly. And lender and mortgage broker, I mean, we're often going, especially on the agency side, we're going directly to just DUS lenders to really just shop them directly.
Yeah, one final point on this, just to drive the point home on how these requirements are changing the equity required. So if you look at today in that second graph that we put together, today to win this deal at what we think it'll trade at, you're going to need $6.6 million in equity. If you were to take that same deal and lever it up to 80%, you need about $5.5 million of equity. So it's $1 million right there. Take that same deal at 75%, but don't require the debt reserve, and you need about $5.8 million. So you're talking about, $1 million+ swing, or 20% swing in the amount of equity that you need to bring to a deal today to win it.
Yeah, it's significant and it's meaningful. And, I think it's going to be interesting to see how that trickles down. We already know deal activity has slowed down. The question is going to be, how long do these adjusted requirements last? One question for you, Donato, in speaking to the added reserve and lower leverage, what happens with the reserve? How is that? Is it with it for the life of the deal? Is it returned?
Good question, my friend. So we are underwriting, as you would know, Josh, you gave me the nice T-ball question there.
Question. Yeah.
We are, so the reserves will all get released to you should they not be required to cover your debt payments, your tax payments, or your insurance payments. So if your property performs as it was pre-COVID and, you're making all your payments, that reserve will get released to you. And there's calculations included in every loan as a mechanism for how that gets returned to you. The way that we're underwriting projects, even though we are underwriting things much more conservatively, we're also assuming that some of that money is burned up through bad collections above and beyond the bad collections that we're already underwriting. So we're just trying to be a little bit more conservative and give ourselves a little bit of a haircut there to make sure that we don't run into trouble, because everyone makes mistakes in investing, and we've learned over the 8 years what to do, what not to do, and we know that doing this is the right thing. And maybe we won't win every deal because of it, but we know that at the end of the day, our investors' money will be safer.
And then to the question that came in, sorry, I mentioned DUS lenders. So DUS lenders stands for Delegated Underwriting and Servicing. Basically, Fannie agency loans, Fannie or Freddie loans, can only be originated by approved lenders. So you have a fixed list for both small balance or non or conventional size loans of lenders that are approved um, to underwrite and really fund those loans. And that's when so we'll go directly to those servicers or originators, whether it's, and you could Google them, whether it's Berkadia, Arbor, Walker Dunlop, Hunt is a direct servicer. So any of them, I would say that if you haven't borrowed and you're not Fannie or Freddie approved yet, the process is definitely more arduous. And I could definitely say that lenders are going to be that much more conservative right now for first-time borrowers. So I would definitely suggest just engaging a mortgage broker if you're looking to do your first agency deal, you know, on your own. That way you could have some hand holding and you could have the I guess the answers to the questions that you know are going to come.
Yep. All right. So now, you know, what has changed on the equity side from what we're seeing? So while investor demand for other types of real estate has changed dramatically in the past 6 months in ways that I don't think anyone would ever anticipate, demand for multifamily still remains very strong. As everyone knows, there's been some top sector pullbacks, especially in hotel. Retail investment is getting crushed right now, and office is somewhat getting crushed because people are just not going back to the offices. However, there's enormous demand right now for multifamily investments because of the perceived safety in those investments, and then also industrial type investments, especially, you know, Amazon type distribution centers and what they call last mile type distribution centers. I know my older brother's also in real estate. He's got a large real estate fund. They invest in actually all of the above. So they're hurting in their hotel portfolio right now, and they're hurting in their office portfolio, but in their multifamily portfolio, they're doing well. And in their industrial portfolio, they're actually about to sell something at record numbers. So it really all depends on where you are in the real estate markets right now, and that's where equity is available. As I said, institutions and retail investors just see multifamily as a way to stay invested in quote unquote the market, but also diversify their risk away from, you know, stocks and bonds and other types of assets that they've been investing in. Okay, so how are we, besides the lending requirements that are forcing us to adjust leverage and adjust debt reserves, what are we also doing to adjust our underwriting? So if you look at our new underwriting, notably, we still, in some cases, are keeping that 3%, which is basically an industry standard for rent increases. I'll say we're doing it specifically on this deal, which is a little bit different than other deals we're doing. We're actually very close on another deal, or about to go into contract on another deal where we have that first year 0. And the only reason why we have this first year at 3% is because there is a gap to market that exists today. So we're just underwriting that gap to market that exists today. And that first year, we're not really saying there's market growth. But if you do look at the second line down, you could see that we're also showing a big 6% lease loss. So in the end, what's actually happening here is we're saying, hey, for year 1, we're going to hit some hiccups. And although we're gapping to the market of that 3% up top, we think that there's the potential that things are 6% worse overall. Then you could also see vacancy is a little bit higher. Again, this project was pre-leased to 100% and currently occupied at 98%. So for us to have a 6.5% vacancy, we are predicting that things might get a bit worse in the next 12 months. And then you could look at bad debt. So bad debt on this property was 0.5% for the historical 12 months. If you look at our new underwriting here, we have 3% for the next year. So that's a six-fold increase that we're projecting. And again, I'll use the word projecting throughout here, but really it's just a conservative measure. Do I actually think these numbers will happen? No, I don't. But do I want to underwrite that way to be safe? Yes, I do. And then just the last one, down to concessions. We're showing a 1.5% concession. This is a threefold increase from what the property is currently operating at. So all in all, you could see that, especially that year one, and then you could look, drag it over to year two. You could see much more conservative underwriting than if we go down to the next line now. So for example, in our pre-COVID underwriting, we would have taken this deal, increased it at 3%, and then taken a modest 3% lease loss on those numbers. We would have kept vacancy probably the same, although there's a chance we would have argued that back and forth and maybe put that down to 5%. But bad debt and delinquency, there's no way we would have had that at 3%. We would have had it at 1%, which was double of what the property was currently operating at. And then concessions, again, it's running at like 0.5%. We would have put it at 1% just because we want to get those second time roll of the leases up in value. All in all, if you look at the average rent from the old underwriting to the new underwriting, in year one, we're talking about like a $40, $50 difference in average rents. So that's a pretty big difference in average rents in the way that we're underwriting. And that really, does affect the value that we're willing to bid on a property right now. All right, so having said all that, what's going on in the markets? Like, what are we seeing in the markets? And please, if you guys are active in the markets or active in investing, type something in, raise your hand, and, get involved and tell us we're wrong. We're happy to hear that. Investor demand for multifamily definitely remains strong. Our investor group it wants to remain active and wants to invest in something before the end of the year, and that's what we intend to do. It has become more difficult to travel freely to properties. I know Josh and I don't tell the governor, but we have traveled down south to both check on our properties and look at new properties. For all of you living in New York, don't worry, we both got tested at separate times when we got home and came back clean. But this is making many offers to go sight unseen. So previously, 6 to 8 months ago, if you put an offer in and you never saw the property, you were not going to be considered as a serious bidder for that property. That has totally changed now. Now they expect if you're in the best and final group that you go down and actually see the property you're bidding on, which is kind of crazy. If you would have asked me that 2-3 years ago, there's no way I'd put a serious bid in for a property that I'd never seen before, but it's just what it is right now. And there is a little bit of flexibility to allow for people to get down there, only if they're, in the best and final and have a real chance at winning that deal. Then you go see it and you could adjust your bid if need be at that time. I think it is also forcing brokers to be a little bit more transparent with condition of properties, because if you bid, a high bid because you're going based off of a broker video tour and everything looks fine and dandy, and then you get there and the place is a crap hole, excuse my French, you're just going to pull out and you're going to pull out your bid, and it's going to make the broker look bad at the end of the day. So I think they're being a little bit more transparent than they usually are. Some owners are still expecting pre-COVID pricing for their properties. Again, 2020 was shaping up to be a record year in real estate. Some of those owners put their selling plans on hold and now are coming back to the market and seeing what they could get for their properties, but they're literally just pricing them as if it was pre-COVID, which in our opinion is very unrealistic, but that's some of what we're seeing out there. And we're frankly seeing some properties that have to adjust their expectations late in the bidding process or end up not selling during that first bidding process. Next, buyers just can't pay what they were willing to pay pre-COVID. And that's pretty clear from the examples that we've been showing. You need to bring more equity. So if you need to, produce a return on that more equity, you need to pay less for those properties in order to make it work. So all that being said, there is somewhat of a dislocation in market between buyers and sellers right now. So we are seeing a bunch of stuff come to the market. It was very, very slow for a while. We are seeing that dislocation now. This has led to an overall reduction of listings on the market for the whole year. And I think everyone, probably if you just think about that for a couple minutes, it all makes sense. But the good news is there's definitely deals to be had out there. We are literally hitting the pavement. We've been calling brokers. I think we counted our pipeline last week, and we had underwritten something like 20 deals in 2.5 weeks. We're really calling all the brokers, trying to figure out what's out there and what we could grab a good deal at before the rest of the players come back to the market and start scooping these things up. So Josh, maybe you want to jump in on this and just reiterate some of the types of deals that we're looking at, which include the new construction, distressed assets, and people who just want out because, it's at the end of their investment timeline.
Yes, definitely. And I think, to your point above, even before touching on that, I guess part of it remains to be seen because especially April, May, June, there was such a freeze in just transactional volume. You were really only seeing deals close that had been engaged pre-COVID and or were 1031 driven deals. Now you definitely are seeing there's a lot of marketed deals. You're seeing deals go through the entire process. If I had to guess what type of discount you're seeing on the deals that do trade, it's probably only 5% from where deals were pre-COVID. I think especially the quality deals that can show just strong collections throughout all of this, they're almost in a better position than prior. However, they're met with the debt challenges that Donato referenced, and those debt challenges are real. And additional equity means that you can pay less ultimately at the end of the day. We definitely do believe there's just deals to be had. We are believers in new construction deals. We prefer to, even new construction deals, find some sort of a wrinkle or opportunity, whether it's a gap to market that we believe in, or maybe it's a lease up play where it's partially leased up and we're taking the risk to finish up the lease up. But we are going to always be chasing some level of value creation on the new construction side. We've been competitive, especially in the deal size that's a little bit smaller for new construction assets. So, we talked to Riverside, 102 units. We were close on 70 unit deal, also new construction. We're offering on an 80 unit deal probably next month. That's an off market newer construction deal.
We're offering on one tomorrow, Josh.
And tomorrow, yeah. And actually to that point, that broker called us this afternoon just really to check in and adjust pricing expectations at the end of the day.
His expectations, not ours.
Yeah. So not a 10% discount that he was telling us, although we're probably offering about 10% off of his initial guidance. But it's about a 5% drop, and that you were not getting a call about 6 months ago. So it just goes to show that just there's a difference in expectations that's out there and real, which I think is probably healthy.
Yeah, and I think just to add, one of the reasons why some of this product just has to sell, people ask us all the time, it's a new product. Why would they sell? Or it's a, well-performing asset. Why would they sell? Sometimes it's just debt timing related. So when you go build a new construction product, you have a construction loan, and those terms are often, 3 years with a 1-year extension or a 2-year extension. If you're at the end of that term, you might not, you can refinance, of course, if the project is doing well, but you may not want to get into a long-term debt. So your best option there might be to sell and reinvest that money into land, which there may be much greater opportunities in right now because, some developers were, caught with their pants down, and there might be greater opportunities for that developer who has a successful lease up to take his money out and go buy land at a discount to start the cycle over again. So that also exists with existing multifamily. If your debt is up, it might still just be a good time to sell, and you could take a little bit less money because you still made a whole lot of money in the run up in this market.
So that's new construction. That's number one, which we spoke to today. Distressed assets, obviously, as I started speaking earlier to just the impact of COVID, we do believe is going to be distressed assets that hit the marketplace. Much of it need driven because just the support is not there. I mean, you're still seeing eviction moratoriums, and landlords are just not necessarily getting relief as a counterbalance. I think that it may take some time, and I don't see there being wild waves of distress, especially because in theory, there should be a correction that happens fairly quickly with a vaccine. However, I think it's going to be out there, and there's going to be situations where there's going to be some outsized upside. We know of there's large investment funds being raised to go after distressed assets, and I think you will see it, and there are secular opportunities that could definitely be invested in, and you could do really well with. I could tell you we have not seen too much, especially in the markets that we're focused on yet at this point. And then 3, people who just want out. So this could be for a few reasons. Donato mentioned a deal earlier that we're very close on. We actually just received an accepted LOI this morning, which is someone that's actually going after, as I say, there's little distress. He's going after a very large portfolio of deals. It's like a 700 unit portfolio. He bought the property that he owns. It was a 1031 for him. There's a quality location, quality deal. He put long-term debt, but it's a low leverage loan assumption, which is not the most attractive for people to step into. And we're going to be able to step in and buy it at the exact same, basically within $10,000 of where he bought the property over 2 years ago. And he spent money and made some improvements, and we're going to be able to continue on that progress at really a great basis in this environment. And he's going to redeploy, and it's really just finance driven, call it motivation to sell. So, that's one example. I think I mentioned earlier, deals with the story, the long-term owner, the motivation, someone, obviously estate situations can always be compelling. But those are the types of projects that we're always looking to chase because I think you could really create some just significant value on, again, the story.
All right. So all that being said, how does it all come together, right? So in the example that we've been talking about all night, the Charlotte, North Carolina, 102 brand new units, beautiful building. It was built to look old, even though it's new. Has some great amenities. It's right on the river. We could pay $1.5 million more for that deal had we bought that in January. Now, you may say, lucky we didn't buy that in January. Time will tell. But right now, that's what our model is telling us. And, models aren't perfect. I get that. But just the way that we're underwriting and the way that we're thinking about things, compounded with all the lender requirements, that's what it's coming out to be. $1.5 million more we could pay in the marketplace pre-COVID. And it's not just us paying the marketplace, because I'd say, maybe we offered on 30 deals this summer. Just today, we got an accepted LOI for our first deal. So, we're offering on all these deals and we're losing on them because we're more conservative than other people. So you could just imagine that other people maybe would have paid even more for that. And all that being said, you would also have better projected returns. So we're at our deal on this one, we're projecting 15% IRR today. Had it been pre-COVID, with paying $1 million+ more, we think we would have gotten to 16, just underwriting the way that we would have pre-COVID. More equity is definitely required to get deals done today. There is equity out there though, so it's just a little bit of a give and take, and people just need to realize that it's good to be safer. I already talked about my next point. The new underwriting is definitely safer, right? The way that banks are making you underwrite and the way that people are adjusting to underwriting is a lot less of a cowboy 2018, 2019 to early 2020. And it's just a lot safer now, overall. So some other things that you could do when you're underwriting in today's environment especially is just check for the downside risks as you're putting your model together. So we actually have something that we built into our model last year. It's called stress testing, and it's actually playing a big role these days. And the things that we're checking during when we put it into our stress tester is what happens without any market growth for the next 2 years. Does the project still cover debt? Does it still make sense? What's the break-even occupancy today? So we're only looking at deals where the break-even occupancy / collections for the project is somewhere around net 80%. The deals that we really are pushing forward on are somewhere around 75%. So that would mean that 25% of the property is either delinquent or vacant, and we're still able to cover our debt service. So, I think that's very conservative, and, it's just protecting us and our investors from downside risks so that we don't make mistakes during this time that we don't need to, but there's still a lot of upside for investing right now. So we're just trying to protect people from that downside while giving them that huge upside should we win one of these deals. And then the last thing is cap rate adjustments, right? So I always joke, and Josh always jokes around, that you can make any deal work by just adjusting the exit cap rate. So you really got to just look at the exit cap rate that you're underwriting to, understand what you're doing. We talked to a big investment group not long ago, 2 weeks ago, and they said, we're just underwriting exit cap at the same rate that we're underwriting our acquisition cap rate. So I said, why are you doing that? And they said, oh, because we're convinced that debt as given out by the government is going to remain very cheap over the next 5 years. So that's certainly a take on the market right there. I'll tell you that is certainly not what we're doing. We are always building in some sort of inflation into that exit cap to make sure that we don't get burned on that exit. Those are just some of the things that we look at outside of all the other underwriting that we showed you today, just to back check all of our assumptions and try and make the best decisions possible for our investors.
Yeah, I mean, I think to that point, and perhaps in that group's defense, I mean, they're
a huge group.
And
they're successful.
They're extremely successful, very smart people that drive their investment strategy there. I think,
they're much bigger than us.
way bigger. I think, they ultimately, they have to deploy capital at the end of the day. So some of it becomes a risk adjusted conversation of what's their best bet at the end of the day. But when you see especially larger deals trade that, there's so much money right now earmarked for multifamily. Um, these groups are just not going to win deals unless they're assuming exit caps like that. And they're underwriting to a yield ultimately, that if they're hitting that yield and they're confident in all of their assumptions, then they don't care if they could exit or not, because this money wants to be in multifamily for a long, long time. So that's just me coming to the defense of the $1 billion fund that we
And
not
I was just trashing.
yeah.
I will say that for Josh and I, we can only probably lose once or twice before it would be over for us. So we need to make sure that, we don't lose twice. And therefore, we need to be a little bit more conservative during these times. All right. So if you want to learn more, don't miss out on the opportunity of investing in a lifetime. I hope that we didn't scare you guys tonight. It was not meant to scare you. It was meant to show you that there's a whole lot of opportunity out there right now. You just got to underwrite it a little bit differently with a little bit more of a conservative outlook. But the opportunity really is for, outsizing and hitting the deals out of the park, because this is exactly what was happening in the last economic downturn. People's underwriting got more conservative, right? And then the market bounced back and they bought those deals under those conservative measures. And what happened? They all look like geniuses and they hit huge home runs. If you want to learn more about us, more about DXE Properties, we are happy to get on a phone call with each and every one of you. You could schedule a meeting with one of us. We definitely get on a phone call with you and talk anything underwriting. We could talk through a deal that you're looking at, talk through one of our investments. We are literally down for anything. So www.dxe.properties.com /scheduler. Last, I'll say, we just received a signed LOI today, so look out if you're interested in investing and you are a qualified investor. Look out for communications coming up, because we will have a deal before the end of the year. And last but not least, in 2021, we will be launching our first opportunity fund. So we really do believe in what we're talking about today, and that there is going to be upcoming opportunity. And therefore, we've been working hard all summer to get the groundwork in and get the legal documents together to launch a fund in early 2021 to really take advantage of what we see as an epic investing opportunity. So if you are investing in that, if you're interested in investing in that, it's not available now, but we'd love to talk to you about it. We think it will be a great opportunity.